Diesel sees biggest monthly fall in 26 years. What's happening to fuel prices? That single number resets the braking playbook. The key question is not what happened, but what changes next for operators and users. We will map trigger, incentive shift, and downstream impact before the close. That's not a correction. That's a reset. Here's what most people are missing: this doesn't happen by accident. A 26-year low in a single month means something fundamental shifted in either supply, demand, or how the market prices risk. And that shift has immediate consequences for every industry that moves goods. Let's start with the scale. We're talking about a drop so steep that it hasn't been seen since 1998, the year before September 11th, before smartphones, before global supply chains became what they are today. That historical distance matters because it tells you this isn't a minor wobble. The last time diesel fell this hard in a month, the world was a completely different place economically. So what triggered it? Three factors collided at once. First, demand cratered. Global logistics slowed. Shipping volumes dropped, manufacturing orders contracted, and the freight index, which is a real-time measure of goods movement, fell harder than it has in months. When goods stop moving, the trucks that move them sit idle. Diesel fuel doesn't sell itself. Second, supply increased just as demand fell. And not by a little. Refineries that had been running at near capacity started pushing out more diesel at the exact moment the market could absorb less of it. In commodities, that timing is lethal. Oversupply plus undersupply of demand equals crash. Third, and this is the part traders are obsessing over, geopolitical risk premiums evaporated. For months, traders had been pricing in Middle East escalation. Every headline about conflict added a few cents per barrel to the cost of crude, and that rippled straight into diesel. Last week, some of that tension eased. Not solved. Eased. And risk premiums compress faster than they build. Traders who'd hedged against war suddenly unwound those positions. Now here's where it gets interesting. This matters in two completely different ways depending on who you are. If you're a consumer in India or elsewhere, this is good news on the surface. Diesel prices follow crude prices with a lag of a few weeks. Lower crude now means lower pump prices later. For an economy where diesel powers everything, buses, trucks, generators, farm equipment, cheaper fuel means lower input costs, which should flow into food prices, logistics costs, and inflation. The Reserve Bank of India and central banks globally have been fighting inflation with rate hikes. A natural drop in fuel costs is like getting a free assist. But if you're a logistics company, a shipping operator, or an airline, entities that had already locked in contracts at higher prices, you're in a squeeze. You sold future deliveries at prices based on the old diesel costs. Now your margin evaporates while you're stuck honoring those deals. That's why shipping and trucking stocks got hit this week. For investors, the question is whether this is a dip or a signal. Is diesel cheap because demand is temporarily weak and will rebound? Or is this the start of a longer slowdown? The answer determines whether you buy the dip or hedge against a slowdown. Right now, the bond market is pricing in slower growth, yield curves are steepening, which usually precedes recession signals. Diesel's collapse aligns with that pessimism. Here's the contrarian angle: sometimes crashes are overdone. Diesel at 26-year lows might be too cheap. Refineries will cut production at these margins. Demand will respond to lower prices. And supply constraints often build quickly once prices hit rock bottom. But that's a multi-week play, not tomorrow. The next thing to monitor: shipping indices. If container rates stay collapsed alongside diesel, it suggests sustained low demand. That's bearish for growth. If shipping rates recover while diesel stays cheap, it means demand is returning but supply is abundant. That's bullish for consumers, rough for producers and logistics firms. Second, watch central bank commentary. If the Fed, ECB, or RBI interpret lower fuel costs as a tailwind for inflation, they might pause or cut rates sooner. That would be a major signal. Third, refinery margins. When diesel gets this cheap relative to crude, refineries lose money. Within weeks, they'll cut runs. When they cut, supply tightens. When supply tightens, prices recover. Timing that reversal is where the money is. The bottom line, diesel's 26-year crash is a real economic signal, not noise. It's telling you that logistics demand has weakened faster than expected, risk premiums were inflated, and the market is repricing growth downward. What you do with that depends on whether you're a consumer, a business, or an investor. But ignoring it is a mistake. This is worth paying attention to. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next.